This is Agriculture Today, and I'm Shelby Varner with the K-State Radio Network. K-State grain economist Dan O'Brien jumpstarts the show with the grain market outlook. Dan says where the market currently is and what he is keeping an eye on. Continuing the show is K-State Extension farm economist Gregg Ibendahl reviewing his recent publication that looks into diesel prices for 2025. We are also joined by Andres Garcia as he shares about his work in the grain market. Chip Redmond, K-State meteorologist, concludes today's show with his weather forecast, explaining how our current weather pattern is similar to what usually happens in June and whether that is good or bad. That and more is coming up ahead. You're tuned in to Agriculture Today, and we start our Friday show with the grain market update from K-State grain economist Dan O'Brien. Dan, thanks for joining us today.
Thanks, Shelby.
Dan, starting off with a really simple question possibly, but probably has quite a few answers. Where are we at right now in the grain market?
Well, we are about on April the 24th and 25th. And that means we're not May 1. We're not May 15th. We're not June 1st. Other dates of note with regard to typical planting progress being in late April has implications in the wheat market and hard red winter wheat. Again, we're just about to May. We're not out of the woods by any stretch with regard to freezes and all sorts of maladies that can happen by us being at this point. We're seeing more harvest of soybeans in South America. That'll be coming as hard competition against the U.S. In not too long, we'll see the second corn crop come into play down there. So where are we at? We're in a moderately sideways to I guess I don't know. I hesitate to say we're low prices. We're sure not as high as we thought as many either thought we would be or hoped we would be, but I know I overused this word, but seasonally, we're on the brink of some really important times just coming up. And in fact, we're at a time when the next speaker on your program that will follow, Chip Redmond, isn't it, from Kansas State, what he will say about weather prospects will carry more weight than anything I will say, because I'll be saying, well, we need to listen what Chip's talking about, because the weather that'll be happening in the next 30, 60, 90 days will tell the story. So anyway, we'll watch where things are at. But when you ask where we're at, well, we're May corn closed yesterday at $4.77 and a quarter, and that's the lead contract. And again, take note that it's we're running out of days in April, just about ready to enter into delivery. So we're going to shift our attention here just pretty quick over to the July contract once we get to May 1. And the new crop D's contract closed yesterday at 456 and a half, and that's a so-so situation. We're a little above 450, which means we really don't know exactly what's going on. Again, a lot of uncertainty still out in front of us, but we're at 450 or over, and that number still represents not as bad of a price as you might expect given what the USDA had projected for corn acres in 95.3 million acres. So we have that much optimism out there. In the last day or so, we've had some optimism, some upward movement in the soybean market. Probably of the three major markets that we're watching, the corn market, the hard red winter wheat market, soybeans in particular, and we watch others too. We watch cotton, watch sorghum, and sunflower, you name it. But those are the main futures complex numbers that we're looking at. And the strongest in the last couple of weeks actually has been soybeans. So soybeans closed yesterday. Again, the lead contract at 1053 and the new crop November 25 at 1035. Again, okay bids. It's not 9, it's not 8, but it's not 12 and a half or 13 either. So everything is really out in front of us. And I would say it's not even the weather that, especially for soybeans, we're not as concerned about the upfront weather. We haven't started soybean planting so much. If anything, being planted now, for fall harvested crops will be corn, followed by sorghum and then some beans later on, at least from a Kansas perspective. So anyway, the weather later in the summer will tell the tale on beans. We'll get off into August thereabouts. So again, what the climatologists tell us about their expectations as we move into May and then July and then August will tell as much or more as than what we have right now. And then for wheat, of course, we have impending serious wheat development, harvest following not that long after that. Here in late July, we mentioned this at the start, latter part of April. We're coming now into May, into June. We'll be looking at the prospects for wheat development, wondering if we'll be dry or wet. We catch some rain here in the short run. What will we have once we get out into the latter part of May, into June, and into early July, especially May and June, when we have the reproductive phases of hard red winter wheat crop in Kansas out there, vulnerable to whatever weather conditions might happen. Too much or too little moisture, sunshine, heat, you name it, it's all there. We were thankful year after year for the resilience of the hard red winter wheat crop, and long-term watchers of that crop. How many times have we relied on just tiller growth, secondary tiller growth, to overcome a malady of early sins that have happened with that crop? So anyway, we got all that happening. But July 25 closed yesterday at 550 3/4. When you don't quite know where things are at, I think that's almost dead on even with the reference price for a good long time that we'd had for wheat and government programs, 550. So that's where we are, but we still have this thing going on, this situation where, July may be 550, but we have carrying charges built into from July to September, from September to Dece to March to May 26 of 7.5. Well, at least 7.5 cents, 5, 6, et cetera, month by month going out. So the wheat market right now is signaling, hey, grow this crop and store it. We're going to pay you for storage. So that's kind of what we're looking at. I would say that we do have, in looking at cash prices, again, you can tell wheat harvest is right before us in that the cash prices right now in western Kansas especially, well, these are on the low end. Colby, 463, 473 in Topeka and Garden City, 477 in Pittsburgh. You do see it 517 for higher prices in Hutchinson and Salina and central part of the state. So we shall see. The wheat market had enough negative news happen over the last 1 or 2 years outside the U.S. export competition. Actually, wheat available over in the Black Sea region coming into the U.S. in the last 1 or 2 years, at least parts of it have affected the price situation. That when there is the possibility of something positive happening, I think it's kind of discounted until it actually happens. But Russia has had crop production problems. They're diminishing their shipments in the latter part of their marketing year. That, by rights, in a normal situation, would impact the U.S. wheat market potentially in a positive way. The value of the U.S. dollar here of late, with the economic news going back and forth as we try to decipher all that, weakening a little bit, that also would be a help. Seems that in the short run, that places like the EU, Europe, has been stepping in to fill some of those gaps. But if we were speaking with the Kansas wheat people, they would talk about some points of watchful potential optimism in the wheat market. And the timing of it would be just wonderful, because we'll be coming into a time frame when we've got lots of we'll have harvest wheat prices, probably lows. It'd be a great time to ship a whole bunch of wheat, that get it out of storage, move it out of the country, and reestablish the U.S. strength in export markets. You and I, Shelby, for a good long time, been watching price ratios, key price ratios around the state. And interesting to me that when you look right now at the soybean versus corn prices that have been going on, really we've got Topeka and Salina really a positive advantage towards, neutral to positive for planting soybeans over corn. And that hasn't shown up for a while. And we've got still out to the west, Garden City area, man, they're going to plant corn. That's what they're good at. Plus, that's what the ratios are showing. New crop soybeans versus corn, about a 2.05 ratio. 2.3 is neutral. And also, we've had something else come about. We've got the ratio of hard red winter wheat cash prices in the Garden City area of 473 wheat, 487 corn. So you have wheat prices less than corn, and for livestock feeders that are okay with feeding wheat, there's probably a way to save some money there with that. So some trends like that we're watching. So I guess I would not be of the type of thinker that say, woe is me, all is lost, we'll never have higher prices. Where we're sitting right now, the factors that would bring about higher prices really haven't emerged yet. So I guess we'll check back in 2 weeks, in 4 weeks, in 6 weeks, and 8 weeks to see how that story goes. But we're in the mode where right now the biggest thing that probably positive would be the weather, if it presents any problems. And one other thing, you and I have talked about the worries about U.S.-China relations, what that might do for exports. And here we hear news of late, a softening of tone between those countries, more chance to come to the table. And that's at least part of the issue that's been supportive of soybean prices here of late. So we'll see how that works itself out. So we've had strong statements about tariffs and direct challenges one way or the other on the upfront. But as things have worked out, these countries have come together, and it looks like in a lot of these cases we're heading for more of a moderated, negotiated outcome that's hopefully have more benefits for all parties.
Dan, I appreciate you taking the time to join us today.
Thank you, Shelby. Take care.
That was K-State grain economist Dan O'Brien. We're cutting to a short break now on Agriculture Today, but stick around because we have more for you up ahead. You're tuned in to Agriculture Today, and we continue our show talking about diesel fuel price outlook with K-State Extension farm economist Gregg Ibendahl. Gregg, thanks for joining us today.
Glad to be here.
You have work that you publish on AgManager.info, and it's titled Diesel Fuel Price Outlook for 2025. And why do we care what the outlook for diesel prices could be?
Well, it's because fuel is one of the major expense categories for farmers. Practically anything you either grow or try to harvest, you're going to have to put diesel fuel in the tractor or combine. So it's a pretty important expense to most farmers, and certainly there are times of the year and such that you can buy and maybe get a better price than you can other times.
And what were prices looking like when we looked at last year?
Well, last year, so again, the price of diesel is probably tied pretty closely to the price of oil, so there is a pretty high correlation. It's not the only factor, but it is one of the major ones. So last year, about this time or so, diesel prices were probably in the $70. The oil prices were in the $70 range. They have since declined now. They're in the $60 range. So that's a good sign that diesel prices may be more moderate this year than they were last year.
Do we see a similar thing for gas prices when we look at last year?
Yeah, gas is probably even more closely tied to the oil price than what diesel price is. So for the gas price, certainly a strong correlation there. The gasoline prices are certainly lower than they were too. Gas is a little unusual, though, compared to the other fuel like diesel fuel, because gas follows a definite seasonality. You always see higher prices, almost without exception, almost always from Memorial Day to Labor Day. So that's we see the peak in the gas prices, and then it tends to decline during the wintertime. Diesel has a little bit of seasonality, but it tends to be more in the spring and fall. Really, if farmers are buying fuel on an as-needed basis, they're probably buying at the peak of seasonality for diesel, although the diesel seasonality is not near as strong as what the gasoline one is.
Is the gas seasonality because of summer travel?
Oh, yeah, for sure. People, go on vacations and do that kind of stuff. So certainly the demand for gas goes up during the summertime, and that's why we see prices rise correspondingly.
And you mentioned in this article that you saw a rise in diesel prices in December 2024 into January. And why was that?
The main factor driving the diesel and gas prices is the oil price, but there's some other factors going on there too. One of the main factors besides the price of oil would be our refinery capacity in the U.S. So we're very constrained with our refinery capacity. It would be wonderful if we could ever get a new refinery built in the U.S. or maybe do some expansion. And refineries do have a little bit of capability of adjusting back from gas and diesel Not all of it, but certainly to some degree. So what we usually see happen is probably more of an emphasis on getting the gas demand out there. That's why we see the correlation between the oil price and gas price a little stronger than we do on the diesel side. So there are times actually out there, because we are constrained on our capacity, that diesel kind of gets the short shift, and when our diesel supply really is kind of low to what it is historically. What that means is the price premium between gas and diesel can vary during at certain times of the year. Normally it's probably maybe in the 40 to 50 cent range, but at times it can go up higher. It has been up high as above $1 at times. It has been as low as maybe 5 or 10 cents like it was last summer. So really the reason we probably saw a rise in diesel prices toward the end of the year was the fact that that price premium between gas and diesel started to increase.
And you've mentioned those cycle seasonality of gas and diesel prices. And are you seeing it for 2025? Do you expect to see it through 2025?
Well, based on if we go back to the price premium, what we have seen the last 2 years, we have seen that price premium kind of peak in the wintertime. And then actually it tends to go away or become very small, maybe close to the summertime. And then once the summer midpoint has been reached, it starts to go back up again. So that's why I'm really seeing diesel prices probably decline between now and summertime, especially with the oil price being low. But then I start to see that price premium, but if it follows the last couple of years, it will probably start to get bigger again. So I am kind of seeing like a mid-year increase in diesel prices. But it's not because of the price of oil. Again, it's because of this price premium between gas and diesel we've seen the last 2 or 3 years.
What are some factors that can impact the diesel price?
Well, certainly demand would be one thing. So if we see a strong economy, we're doing a lot of diesel use, and a lot of diesel use not necessarily comes from farmers, but it comes from trucking and construction. Those are all things that are highly correlated to what the state of the economy is. So if the economy is really strong, we see a strong demand for diesel fuel and such. So currently one of the reasons why we see oil prices in the $60 range is probably there's been some indications that the economy may be softening to some degree. You know, certainly tariffs may have a little bit to play in that, or talk of tariffs anyway, but it's probably the fact that there is maybe some softening in the economy, and certainly the OPEC countries have stepped up oil production as well. So you can find maybe traders seeing some softening in the economy combined with a higher OPEC production means that diesel prices have gone down to the $60 range, which is really pretty favorable as far as the diesel price is concerned. The only downside to low oil prices might be the fact that it does discourage domestic production here. So when we reach about the $60 range where we are now, that makes all those fracking wells we have out there in the country really on the verge of being almost at the break-even point here. So really, I don't think we want we don't want oil prices to go really too much below $60 range, because that will keep our domestic production in place. But as long as we stay above that, I think we'll produce enough diesel fuel. And going forward, looking at that diesel-oil price relationship, the fact that we have oil prices in the $60 range means we're probably going to look at diesel prices, I don't think any higher than they are now. In fact, we actually could be at the high point for diesel fuel prices for the entire year.
Is it fairly strongly correlated between what the world oil price is and what we're seeing when we go to the fuel station? Oh,
yeah, for sure. So oil is one of those fungible commodities that's traded across the worldwide here. So, really our oil price here in the U.S. is going to reflect oil prices we see all over here. I don't think there's anything that's really going to separate those here. So really when the entire world economy starts to soften, oil prices here will start to soften here as well here. Really the U.S. could almost be a neutral oil producer user in our own country here. We do import some oil, but again, a lot of that oil we import comes from Canada because it's a heavyweight oil, and we're better set up in our refinery system to use a heavyweight oil. But then by contrast, we're also then set up to export our lighter weight oils that other countries can refine more easily. So it's really kind of a global balance for everything. I hear all this talk these days about tariffs, and they do have some effect, but in reality, I don't think they're going to have a whole lot to do with oil price here in the U.S. because we could be self-sufficient if we need to.
What do you mean by heavyweight oil and lightweight oil?
Well, it's these oils they get from like the sands in Canada. It's just it's also called a sour oil. It's just a heavier grade of oil. It's thicker when you pour it. So it takes a special refinery system to do that. We can do that here in the U.S. because that's the way our refineries are set up. Not all the world can do those heavyweight oils like we can. In contrast, these lighter weight, or what we call sweet oils, they're a lot easier to process. A lot of other countries can do those easier because it doesn't take a sophisticated refinery system like we have here in the U.S.
Is there a chance for farming operations, ranching operations to use risk management or use the seasonality of prices to their advantage?
Yeah, they can. Like I mentioned earlier, typically diesel shows some seasonality. It's certainly not as strong as what the gas one is, but there tends to be peaks in the spring and the fall. So if you're a farmer and you're buying fuel on an as-needed basis, so if you wait till spring or maybe like March or April to buy your diesel fuel, you're probably going to pay a little bit higher price than if you could buy some maybe a month or two earlier, and the same for the fall harvest as well here. If you buy fuel for the fall harvest in October when you're using it, you're probably going to pay a little bit higher price than if you could have bought your diesel fuel in the summertime. So storage for diesel fuel, I think, probably pay for a lot of farmers because it does give you some better pricing options to buy when prices are probably lower. So,
Greg, 2025 diesel prices, what are you seeing? What are you thinking?
Well, again, I think that we probably reached the high point for the year, I think, based on everything that I see. Again, with the volatility in fuel markets, that could change tomorrow here. But currently, the way things look, I think we probably have reached our high point for oil and diesel prices. So really, I expect the fuel cost really to be a minimal factor for farmers going forward. They're not going to pay more than they last year, at least they shouldn't. So that's a positive for farmers that will definitely help their net farm income bottom line at the end of the year.
If people want to find out more information, how can they do that?
Well, all of my publications are on AgManager.info, so go there and find my latest write-up about fuel prices and fertilizer prices as well.
Greg, I appreciate you taking the time to join us today.
All right, glad to be here.
That was K-State Extension farm economist Gregg Ibendahl. I will link his publication in today's show notes on agtoday.net. Before we cut to a break, we're now going to be joined by someone who was at the IGP Institute recently here at K-State for a class to learn a little bit about what trade he does. And we're joined by Andres Garcia from Grupo Crio. Andre, thanks for joining us today.
Oh, hello. Thank you very much for having me here.
Can you tell us a little bit about your job when it comes to grain?
Yeah, I work in Crio, as you said. I'm a risk management. Crio is a company that is in poultry. We sell chicken and eggs. And my job is buying the grains for the feed of the chickens. We buy corn and soybeans. So to protect, to cover, or to having a price of buying the grains. Under budget, we use options and futures in the Chicago Board of Trade. So nowadays, there is a lot of uncertainty on volatility in the market, so it's important having an area in your company to protect your prices, selling and buying prices. If you're a farmer and you want to sell your product, you need to cover a price that is nice for you. And if you're a buyer, you need to cover a price that fits you.
What are some major things you're watching while you're doing your job?
Well, nowadays, the thing that everybody's talking about, the tariffs. We are in Mexico, the president is managing things okay for now. So we haven't been punished with tariffs for the moment, so we're okay. But people are a little afraid of what is going to happen.
We're cutting to a short break now on Agriculture Today, but stick around because we have more for you up ahead. You're tuned in to Agriculture Today, and we conclude our Friday show with a weather update from K-State meteorologist Chip Redmond. Chip, thanks for joining us today.
Yeah, thanks for having me.
Chip, last week you said some places might get too much rain, and have we seen that in this past week?
Well, we've seen a pretty good amount of rain spread out throughout the state, and that's been the one good thing thus far with this weather pattern is it's developed multiple complexes of thunderstorms each day over the last week, and we have not been able to get the storms in the same place multiple days in a row, which has really helped to mitigate any flooding concern at this point. A lot of the reservoirs in the east got big bumps with 3 to 4 inches of rain in the heaviest areas. Some places in southeast Kansas got as much as 5 inches of rain, but now they've had a few days to dry out after that. So it's really been a perfect weather pattern when we think about it. We've had higher humidity. That's really helped limit the amount of moisture demand that the environment has, and so we're keeping that moisture in the surface. And then we put this rain again in places that really needed it. We had a corridor there from southwest Kansas up into north central that has missed out on a lot of the rain over the last several weeks. Those areas got up to 3 to 4 inches in like Lane County. Obviously, you got further away from that bullseye, it's a little bit less, but still widespread rainfall for everyone except for the far southwest, like Hamilton County area, and the far northwest, like Rawlins County area. They still got some precipitation, but not enough to offset their averages. Our averages are still increasing. We're over 1.5 inches to 1.25 inches on average in southeast Kansas and up to about 1/2 inch in western Kansas. So we need that much rainfall just to keep up with average at this time of year.
Did we see some good news then when we look at the drought monitor?
Yeah, so the drought monitor, again, that's that Tuesday cutoff, so it didn't catch all the precipitation, especially in the western half of the state. But we had some improvements in the southeast, south central, where we saw those weekend rains. And then we actually saw some degradation in the west. Again, that's before that precipitation. So they kind of offset each other. So we still have quite a bit of the state in moderate drought, still some severe drought along the Oklahoma border. But I think after the precipitation this week, we'll see more drought improvement next week.
What have temps looked like?
Pretty persistent. We had a couple of days warmer slightly and a couple of days cooler slightly, but overall we're near normal, just slightly above normal. We've got a lot of moisture. This weather pattern is kind of stalled out. We've got high pressure to our east and persistent low pressure to our west, and that's allowing that Gulf moisture to stream northward. And so we've had high humidity. And that high humidity does not allow those overnight low temperatures to fall off. When we look at the next 7-10 days, we're going to keep that above normal trend because now we've got a bunch of surface moisture in the soil. And so that's going to end up being some positive feedback to keep those temperatures down a little bit in the afternoon and up a little bit overnight.
Are we expecting more precipitation next week?
Yeah, so we've got several opportunities of precipitation for the next 7 days, mainly focused more on the eastern side of the state. We're going to have one more system come through on Friday night and into Saturday. And then we're going to dry things out Saturday, and then another system on Sunday. And then we're going to have warm temperatures on Monday as a much bigger pattern change starts to develop Monday into Tuesday. That's going to provide some of the upper-level wind shear we need for some severe weather, mostly for the far east, and then we'll be really warm and much drier for central and western Kansas on Monday. Then a cold front comes through. Should be a couple of days of quieter weather middle of next week, and then maybe some more precipitation chances in the following weekend. Overall, I think the pattern starts to become a little bit less favorable for widespread rainfall as you get into mid-May. And then I think things probably start to really dry out late May. We're in a June weather pattern right now. We've got very poor upper-level winds. We've got propagating thunderstorms, slow-moving thunderstorms. We should be having storms racing along in April yet. And so my concern is that would lead into an overall pattern of just weaker upper-level winds that ends up more in a blocking pattern. And it could definitely lead to higher temperatures earlier in the summer months, and potentially a longer duration summer with more drought concerns than normal. And that's what we've been talking about over the last several weeks. And I think that we're definitely seeing that come to fruition with the kind of precipitation we're seeing right now.
That was K-State meteorologist Chip Redmond. That's all we have for you this week on Agriculture Today, but we'll be back with more for you on Monday.